Hey, we have a disagreement here. My guest coming up and I think differently. We disagree about the housing market. One of us thinks it's healthy, the other one doesn't. We're going to work it out. It's going to be an interesting chat centering around housing prices, mortgage interest rates, what the Fed is going to do, housing supply, housing demand, and more. This disagreement is coming up next. Much like me, today's guest helps others build passive income and ongoing cash flow with real estate so that you can live a life on your own terms. And she does that through her network called Real Wealth. She's the past president of American Women in Radio and Television. And, she just had a great all-around long-time media presence. She's a frequent guest expert on CNN, CNBC, Fox News, NPR, and it's been a few years since she's joined us here on GRE, so it's a pleasure to welcome back Kathy Fettke.
Oh, thanks for having me. It's good to see you.
Yeah, we want to have a housing market update, Chad, and there are always so many variables in the housing market, and it seems like some of them are at extremes today. I think to really bring one up to date on what's happened in the past year, I would look at something that sounds ominous. And with higher prices and higher interest rates, we know that year over year, median monthly mortgage payments are up 56%. And although that sounds ominous, I actually think the housing market is really healthy and there are a lot of supportive measures there, Kathy. But tell us from your perspective, what are your thoughts with today's housing climate?
Well, I would argue that it's not that healthy of a market in the sense of affordability. The Fed has admitted now that they overshot and they stimulated for too long, and that drove prices up because really it became so much cheaper to own a home when you've got 2% interest rates, mortgage rates. So when more people can buy, that drives prices up. And the only tool that they know how to slow that down is to raise rates again. So here we are now in this conundrum of high home prices from low rates. To slow it, they have to raise rates, and housing is expensive. So it's not healthy. It's a sad thing to me for first-time home buyers. And those first-time home buyers are the largest group or generation ever of first-time home buyers, hitting this market where affordability is just not there. And on top of it, supply is just not there. There's not much to choose from. Now there's bidding wars on rental property. So I would argue it's an unhealthy market, but not the way that you're seeing it in the news or the headline or your friends on Facebook or whatever. It's different. The way I see it as unhealthy is different than maybe what other people are saying when they say there's going to be a market crash.
Right. Yeah, we should talk more about what I'm talking about when I think there's a lot of support for the housing market. I agree with you about those wannabe first-time home buyers. Yeah, this market is worse for them. They're the ones teeter-tottering on the brink of affordability, and higher prices and higher mortgage rates have certainly knocked them out of that. I like to often look at things through the lens of supply and demand. For those existing homeowners, maybe for those able to buy rental property, there could be a lot of support there when one looks at supply and demand. It's one of the first places I look. So what do you see through the supply and demand spectrum, Kathy?
Well, every market is different, and that's really important. We often talk about housing markets, but you and I both know that every market is different. There are going to be markets that are oversupplied. There are not that many, though, and a lot of markets that are undersupplied. And it just depends on what's happening in that area. Is there job growth? Has there been a lot of builders in the area bringing on new supply? Is there population growth? Have prices gone up so much that people are going, you know what, I can't live here. I'm going to go somewhere else. So every market is different. I think that we're going to see I personally, this is my prediction, is that certain markets that really got a big boom over the last couple of years, you can probably name those markets. We know Boise, Idaho, prices went up 40% in 1 year or something.
Boise, Phoenix, Austin, Nashville, yeah.
Those markets. I don't really see prices increasing much more in those markets, even though they're still extremely desirable for young people, for millennials, for these first-time home buyers. It's just become so expensive. And then we've got markets that didn't really see a lot of new supply. They didn't have builders coming in because maybe they're just not that attractive of a market for a big builder. Those areas, I think there's still a lot of upside. So I'm excited. And that's always been the markets that I've been interested in, is the kind of off the radar ones, because the big builders, they're going to go to the Atlantas and the Dallases of the world. That's where they're going to make their money. But when you go to, say, for example, a little market like Cincinnati, Ohio, I think we've seen prices go up there quite a lot, but it's still so affordable compared to other areas. We are actually at Real Wealth. We're building. We have now 6 syndications that we've done where we're building homes. And one of the markets we chose, without really knowing, this was pre-COVID, so we had no idea how it would pop, but Bozeman, Montana. That's another market where there's tremendous demand, because now more people can live anywhere. It's tremendous demand to live there, but there are really no other builders. We just kind of got lucky, got in there. There's no national builders. So not a lot of new supply, and yet a lot of new people moving there, especially thanks to, the Yellowstone, the show. I don't know if you watch it, but people watch Yellowstone. They're like, oh, I want to go live there. It's a great show.
It's been good for the local realtors there.
Yes.
Yes. Well, we think about housing at its most fundamental level. We're talking about housing people, and that begins with demand. And we are in this demographic patch where 28 to 34-year-olds are the most populous cohort in all of America. And why that's important is these are people of prime household formation years. So when one wonders, where does this demand keep coming from and what's going to push demand in the future, oftentimes it comes back to that 28 to 34-year-old cohort.
Yeah, that's exactly it. We've got this huge group of millennials that are forming families. And there was really a lot of misinformation over the past 10 years that supposedly millennials weren't going to behave like other generations and somehow wanted to live downtown all their life and be single.
Right.
We're talking about a kind of a very big generation. If we're looking at, people in their 20s all the way to their almost 40s now, you just can't compare a 40-year-old with a 25-year-old. They're definitely at different life cycles. But 10 years ago, when there was all this talk about millennials being slow to the game, they were in their 20s, like who's buying houses and forming families at that age? They weren't ready yet, but they are now. And because builders haven't built enough to keep up with them, and there was just a misunderstanding of this generation, here we sit with no housing for them, whether it be rental or to buy. And it was really sad. I've been trying to tell as many people as possible, especially when interest rates were low, like lock it in. But right now, there's bidding wars on rental property. So if you're in a position to be able to buy property today and rent it out, you're really doing a great service to these people trying to have a roof over their head, especially if you can find property that's affordable, generally affordable for the area. You're doing a great service, because maybe the people who want to live there can't buy it themselves at this time, maybe when rates go down, but not right now. But if you can, then you're able to maybe not cash flow as much as you could last year when rates were lower. You can still cash flow. And then in a year or two, lower your rate again, refi into lower rates. I'm pretty sure we're going to see that again. Then, you've done a great service to the young people of the world today.
Yeah, 2 34-year-olds that live above a gym downtown and have 2 kids probably aren't going to be living there very long. They want to get out into oftentimes a single family home and spread out. Yeah, from the humanitarian perspective, it's not a great housing market. I mean, if we don't have adequate housing for people, it's really unusual. It's really unfortunate. We put a man on the moon in 1969, but we cannot adequately house people in the 2020s. But from an investor perspective, for things that support prices, this is what I mean, it is a healthy market from that perspective. We talked about where the high demand is coming from, and then we look at supply. We look at a metric like the Fred active listing count, where oftentimes there are about 1.5 million units seen as that kind of supply demand balance. And we have only about 600,000 units available now. So therefore, we're down about 60% in supply. just from 2016. So high demand coupled with that low supply. And these are two conditions that aren't very malleable. They're pretty rigid. You can't change demographics that quickly, and we can't bring enough supply online very quickly. They're inelastic conditions. So this is what I mean when I talk about a healthy housing market being supported from a supply demand perspective.
Yeah, I mean, people talking about a housing crash, either they're just really hopeful that they can get foreclosures for cheap. Right. You know, I mean, I don't know why people are coming out with that, but you have to ask yourself, if you owned a house that you bought last year or the year before, or let's say 10 years ago, and you locked in a 2 or 3% mortgage, and now you've got, 20 something, I don't even know, but an enormous amount of equity, a record amount of equity in these homes because prices have gone up. And so people are sitting on a low payment with a ton of equity. And, why, just because days on market have increased or there's, sales have dropped, you're suddenly going to go, I got to sell my home with this really cheap mortgage. Nobody's doing that. If anything, the fact that mortgages were low for so long, people are going to hold their homes, because why would they sell and pay more and have a higher mortgage?
Right.
That's going to affect supply as well. So the idea that there's going to be some kind of housing crash, people are just not looking at the fundamentals. That it's very clear that though today's current homeowners are in the best position they've ever been in, with the lowest rate, basically the payment that they're paying is the lowest percentage of their income that we've seen, because again, the payments are locked in and they're low. So the idea that somebody loses their job and they're going to go, oh no, I'm just going to have to turn my house into the bank and not collect all that equity. No, you're going to, if you need to, you'll put it on the market and you'll sell it. Now, there are people who are deeply affected today by the rising interest rates, homeowners. And that would be people who were expecting to flip a property maybe, and now are stuck because they were maybe in a hard money loan and they were planning on flipping, and now maybe the market's not there and they have to lower. So I'm definitely hearing that flippers are challenged today. Anytime you're in a short-term loan like that, or needing to sell rapidly, then you could find yourself in trouble. But people who would just want a place to live, now, maybe if somebody got a new job and they have to move to another area, they might decide, maybe I should keep this home and just rent it out because there's so much rental demand, even if they've never been a landlord before. And then they might go rent somewhere else, to keep that house because they're locked into that low rate. So this idea that there's a housing crash, no. Are prices going down? In some areas they are, because if you're looking at the data and saying, okay, the Fed right now is intentionally trying to reverse the mistake they made, and they're raising rates. They're making the cost of money more expensive. So yes, there's an opportunity right now to negotiate with sellers a little bit better than you could over the last few years. There was
you can actually ask for some inspection findings and not have to deal with all cash offers for a change. Yes, as the housing market normalizes somewhat.
It's coming back to a little bit closer to where it should be when people make as an important decision as buying a home. You should be able to inspect it. I can't believe that there were cities like San Francisco where no, you just buy it as is. And the seller would put it up and say, if you're going to ask me any question, you don't get it. I'm taking the next person in line who will just give me the money. That's not healthy. So I'm so glad that the days on market that it's increasing, and that now buyers can take a little bit more time. That's not everywhere. Some markets are still red hot, but in general, days on market, it's increasing. That's a good thing. That's a healthy thing. That means that maybe people who bought just this past year might see the house next door go for less than what they paid. That's possible. But that would probably just be the people who bought last year. And these people who just bought in this past year, they probably don't care. My daughter's one of them. She probably paid top dollar, but she's locked in to a rate that is lower than the rents.
Yeah.
So you know what? She didn't buy that house to live there for 1 year. She bought that house to raise her family and her son, who's in a great school district. So yeah, the people who bought this past year, they might kind of scratch their head and say, shoot, the house next door to me is selling for less. Bummer. But you know what the difference is? The payments might be close to the same, or the person who paid more might actually have a lower payment and be living cheaper than the person buying the cheaper house today. Does that make sense?
Yeah. And, you talk about the word crash. I think that's such a popular word in media headlines. That's the sort of thing that gets clicks. And yeah, I don't see how any price crash is imminent, defining crash as a loss in price of 20% or more. But yeah, it's funny with some of these headlines, Kathy. I mean, I was talking about supply earlier. If supply in a balanced market is 1.5 million homes and we fell to 500K, well, if we've gone from 500K of supply up to 600K of supply, that's a 20% supply increase. And you might see a headline out there that supply is up 20%. And that makes some people think that, oh my goodness, we're going to be overrun with a glut of homes. But no, overall, we need 1.5 million just to get back into supply and demand equilibrium. So sometimes the sensational headlines need to be taken into perspective, is what I'm talking about. But I heard you talk about dropping prices, something that I don't see happening in very many markets now. You're just talking about a few markets? Are you talking about a year-over-year price decrease in any U.S. markets?
Yeah, it is starting to happen in places like Seattle, some areas that really saw massive price growth. They're starting to see a softening and price reductions. But I would just chalk that up to aggressive sellers not understanding today's market and thinking they can still put up a sign on the yard and sell at top price without doing a darn thing to the house and maybe not even clean it up, So we're going back to a time and not a balanced market yet, but at least a time where you have to try a little to sell your house. You have to make it look good and maybe do the landscaping and, have all the marketing in place and so forth. And there's some agents and sellers who got a little lazy and don't think they need to do that and are having to reprice. So that's a good thing. That's a healthy thing. It's moving us back into a direction where things should be, where people can stop and think before they have to make the biggest purchase of their life. But again, for your audience and my audience, we want to probably know how this affects us as investors. And I mean, just look at some of the recent headlines, these multiple offers on rental properties. It's incredibly sad that, even if you just want to rent a home, renters are probably the most challenged today because I believe the percent of their income that they're spending on housing has increased dramatically.
Sure. And this is all the time when they have inflation increases in the cost of their gasoline and their insurance and their food and everything else. It's a really tough time for them.
Yeah. So if there's, for people like us who are able to either provide new supply or go in and buy old houses and renovate them to be, more rent ready if you're able to provide some form of affordable housing, which is, I know is what you and I both really focus on.
Yeah.
That's, again, a great service for people who maybe don't want to have to move in with mom and dad, and maybe mom and dad don't want their kids to move back in with them. Being able to find a way to provide housing is so important. I know that some groups are taking hotels and turning them into apartments. And now that's causing a problem with hotels where there's not enough, overnight stays, which might be good for Airbnbs. It's just a very interesting time and it's not going to last forever. It is probably the next 4 years, maybe 6 years of this rabid demand for housing. And then after that, it'll calm down. So, there's this concern of, let's not overbuild for that time, maybe 6 years from now, when now everybody has a home. But I don't see that as a problem because I'm in the building industry and we're having the hardest time getting anything finished. So I don't really see a threat of overbuilding either at this point.
Yeah. And when it comes to pricing, sometimes a seller sees that, for example, in a market, housing values have been up 20% year over year. So they go ahead and put their property on the market and mark it up 20% over what it had sold for previously. And then they find they need to make a price cut and maybe come down 10%. Well, it will still sell for 10% more than what it did in the market last year, but yet that often gets reported as a price cut. Sort of a difference there between a price cut and a year over year decline in prices. Yeah. And so much of it comes down to that supply. We can look and see there's about 2.6 months, again, nationally, of housing supply right now. Historically, typically when we get up to 4 months of supply, we have something like 4 to 5% appreciation, and we still have substantially less supply than that right now. I like how you bring up the fact that existing homeowners, they are in pretty good shape. Now, 40% of homes don't have any mortgages on them at all. And then among those that do, the average loan to value ratio is 30%. So to your point, we don't have a distressed homeowner, and they wouldn't have to walk away and create values to go down. They could just sell the property. So to give an example, for a 30% loan to value ratio on a $500K home, that means a person would only have a $150K mortgage. So you do have existing homeowners in pretty good shape. Much of that is due to the fact that their mortgage was underwritten pretty conservatively for most people that are homeowners today.
Yeah, I mean, you nailed it. You're going to have a housing crash when you have distressed homeowners. That is not what we have today. We did 10 years ago, for sure. But that's not the problem today. So, whenever I see a post on Facebook, and I swear I just have to get off Facebook because it drives me crazy.
I know.
Whenever I see, prices are crashing, and I'll just say, where? I'd love to know where. And then crickets, I don't hear anything. So, I understand there's fear out there. But my advice to people is, if you're going to read a headline, at least read the article, because the headline is meant to scare you. It's meant to get your attention so they can sell ads to you. But when you go and read the actual content, then it's not as scary. Like you'll see, housing collapse, and then you read a little bit. It's like, oh, sales are down. Sales are down. I see. Yeah, that's not a housing collapse. It's just there's not inventory out there. Sales are down 20%. That's not the same as prices down 20%. But you have to read the fine print, right?
Sure. A lot of readers don't realize oftentimes the article writer and the headline writer are two different people. And the headline writer is there specifically to bring in clicks to the article. And the article's what really gives the information. But yeah, some people don't want to read.
Please read the article.
Yeah. Well, Kathy, I know that you like to talk about what the Federal Reserve is doing and their moves, and they've made so many headlines recently. As we know, almost 2 weeks ago, inflation was reported at more than 9%, a high for this era. Currently, the federal funds rate is just below 2%. 2 days from now, they have another meeting where a lot of people feel like it's going to be hiked up to something like 2.5%. And, I think the Fed, they're trying to fight a supply issue by sort of stomping out some of this demand. Mm-hmm. So talk to us some more about what you see the Fed doing in the future and how that can change interest rates from your perspective.
Well, it was my belief that we had hit the max on inflation. So I really thought we were going to see things slow down. And the inflation numbers are delayed. They're not the most recent numbers, but the Fed has to respond to it either way. They've already come out and said they're going aggressively after inflation, and they want to bring it back down to the target of 2%. And the only way they know how to do that is to pull money back out of the system. Now, they flooded. This is like a tsunami of money that came into the system, and there's going to be damage from that. They flooded the market with money, increased the money supply by as much as 40%. I've heard even more than that, but that's what we've seen. So yes, of course, there's going to be an impact of that much money chasing goods. Prices go up, especially when the things that people want are limited. So now the only thing that the Fed knows how to do to correct this incredible error is to pull that money back out. And there will be consequences to that, sadly. There will be job losses. I mean, we're already seeing it with any industry that really boomed during the last 2 years. It may have to pare back now. And one great example of that is the mortgage industry. Mortgage companies are going bankrupt left and right and laying people off because, who wants to refi, at today's rates. So you're going to see headlines like that. There are going to be industries where people lose their job because the demand just isn't there anymore. That's what the Fed is trying to kill, demand. And they're going to win. So as we see that happen and there's more layoffs, I know it sounds terrifying and awful, but this is a really good time to be laid off. Someone who gets laid off from a mortgage job, you can look at that headline and say, oh my gosh, thousands of people just lost their job. But you know what? There are so many jobs out there. There's 2 jobs for every person that wants them. What we need is people to want jobs. So if somebody's going to lose, if a company's going to lay off thousands of people, that's great because there's another company ready to hire those people. People getting laid off today are not walking into a 2009 market where there's no jobs for them.
That's a very interesting way to look at it. It's never good to lose your job, but if you're ever going to lose it, now might not be a bad time, as there are about 2 open job positions for every 1 person that's seeking work. And that plays into the Fed's dual mandate. Their dual mandate is high employment and stable prices. By conventional measures, are doing pretty well with high employment, but they're not doing so well with stable prices. That's why we expect the rate hikes to continue. Well, Kathy, why don't you wrap it up for us, especially through the perspective of someone that's looking to add income property to their portfolio today, and just how that climate looks for them, given this heightened demand for rentals and so many people not being able to afford their first home?
Well, I've been a contrarian all my real estate life, just looking for what other people can't see. So personally, and I'll just whisper it here on the show so that nobody hears it, I just think this is one of the best opportunities ever because there's so much fear from these headlines that people unfortunately look at and listen to and believe that, there's more opportunity to get deals, to negotiate with builders, to get new homes, to serve this desperate demographic looking for housing by providing them rental property. So I personally am going all in for the next 6 months because I think there's going to be more opportunity than I've seen in the last year. It was so hard to try to acquire any real estate over the past year because there was so much competition and people driving prices up. But now, no, I mean, this is a great time to get in, even if the numbers don't make sense right now because of the high mortgage rates. If you're able to lock in a property at a price that makes sense, I truly believe that we're going to see rates go down again. When the Fed gets what it wants, which is to kill jobs and kill demand, then they're going to have to reverse again and lower rates. And a lot of people are saying that's going to happen next year or the year after that there'll be a reversal and they'll have to stimulate the economy again. So you can get the great price today and then just refi into a lower rate later, So that's what we're looking at. And that's why a lot of people are doing ARMs to kind of make the numbers make sense today. I normally always get a 30-year fixed rate mortgage. That's always my thing. I feel safe there. But right now, I'm not worried about getting a 5-1 ARM. It's fixed for 5 years because I'm probably going to refi in a couple of years.
Sure. I was having just that discussion on the show a few weeks ago. Sometimes 10-1 ARM rates are really pretty attractive. That means your rate stays fixed, even on an ARM, for those first 10 years. Hey, well, Kathy, it's been great to get your insight on where you see the housing market. It sounded like we were going to disagree on a lot of things when you talked about an unhealthy housing market in the beginning, and I talked about a healthy one, but when we got into the nuance, I could see that we do see a lot of things similarly. It's been great having you here. Thanks so much for coming onto the show.
Thanks for having me.